Welcome to Kaizen Time, part of the Blood, Sweat, and Business podcast, where we provide constant improvement to businesses through timely, actionable financial solutions. Do you want answers to your financial questions? Email us at bsp@kaizencpas.com. I'm your host, Mark Valesky. Now let's get started. Welcome to another episode of Kaizen Time. I'm joined by Eric Jorn, a partner here at the firm. What's going on, Eric?
How you doing?
I'm doing all right. How are things in the big city?
The big city of Antioch, Illinois. They're doing well. They're doing well. The sun's starting to come out. It is getting nice. It's getting nice out. It's staying bright out longer. So all the good things are starting to happen again.
Yeah, it's throwing me for a loop because usually I'd be like, oh, it's dark. It's time to go to bed. And now I'm like, oh, I guess I stay up later now.
Yeah. No, I hear you on that.
Eric, we're going to go right into tax strategies. And what are some strategies that people aren't really talking about?
Yeah.
What are things that, and this could go for just us, like an individual person, but in general, like what is being missed by other CPAs, small businesses?
Yeah, definitely. So I oversee our sales and marketing function where we see hundreds of businesses' tax returns prepared by all our CPAs. And if I would say the most common available yet missed opportunities that we're seeing from those prospects that we're meeting with, really I'll talk about three major ones. One of them is managing officer comp inside of an S corporation. That one is probably the number one. It's the easiest way that we see a small business owner get an immediate tax benefit. Another one is it's still kind of tax law, but we're getting to a point where it's pretty much set in, and that's pass-through entity taxation. That's another one that we're still seeing missed. And then the qualified business income deduction, while we see it come through, what we see is a lot of errors with it, and a lot of it's not planning with their accountant to maximize that credit. So we'll talk about those three items today.
Perfect. All right, then let's start from the top because I want to know what kind of is being missed.
Yeah, definitely.
So managed officer compensation.
Managing officer compensation. Yeah. So probably about 95% of the businesses that we see come through the door end up are S corporations. So S corporations are, if you go out and you say, hey, what type of tax entity should my small business be? You're going to see S corporation pop up all over first. And more than likely you start off as an LLC and then you make a tax election to become an S corporation because you're going to save money being an S corporation, which is totally true. However, what we see happen is we'll see it on two ends of the spectrum. So you have you have your single member LLC, you're starting to make money. Somebody says you should be an S corp. So you go out and you file an S corp election. Well, as a single member LLC, you never used to have to pay yourself compensation as an owner. You could just take draws from that LLC.
Because you're connected to the business.
Exactly.
Your finances are one.
Exactly. Yep. Now we're an S corporation. We've created a separate tax entity. Now I'm an owner employee of that S corporation and I need to compensate myself fairly. It's an IRS regulation. So you can't be overzealous with the benefits of the S corporation. So one of the issues we see is officer comp is zero. We have profits, meaning the business is profitable. We've taken that money out as distributions, just like we were as a sole member LLC, but we took no officer compensation. This is one of the biggest red flags we see from the IRS standpoint, especially revolving around officer comp. That's one of the things that they are narrow focused on is that particular situation. So that's one error. Now that's not going to save you any money. That's actually going to cost you money once you have to take compensation, but it'll save you money in the long run if you were to get audited because they would reclassify your draws as wages. And you'd have to pay back taxes and back penalties and interest on that money. So that could save you money in the long run. But let's talk about where you will make more benefit.
I think that's going to offset this, right?
Yep. So same situation to become an S corp. And my accountant says, hey, you need to pay yourself on a W-2. So I'm like, oh, okay, well, I used to draw out $150,000 out of my LLC. I'm going to pay myself a salary now of $150,000 because that's what I need to live off of. Well, we just pretty much eliminated the major benefit of being an S corporation, and that is saving on FICA tax. So once we hit about $150,000 of compensation, we are now at the Social Security tax limit. So let's step back and talk about FICA taxes. What are FICA taxes? Social Security tax and Medicare tax. So me as an employee, I pay in 7.65%, and my employer matches that 7.65%. So a total of 15.2% is what you pay in FICA. And that runs up to about $150,000 in wages. And then that drops down to 2.9%. We're only paying in for Medicare at that point. Social Security hit its limit, drops off.
Yeah.
When I'm an S Corp, my profits from my S Corp are not subject to FICA tax.
Oh.
So right away, hey, I flip the switch and say my LLC, my sole member LLC, I paid self-employment tax, which is FICA tax. I paid my 15.2% on that $150,000. I'll make myself an S corporation. That 15.2% goes away. Great. However, I got to pay myself my reasonable comp. But if I was paying myself my $150,000 on my W-2, and so let's say I bring that down, I go out in the field, do research and say, hey, what am I doing? I'm just doing some administrative oversight of the business, doing X, and with market research, reasonable comp for that is say $60,000. Well, if I set my salary at $60,000 and I leave the other $90,000 to be profit and profit distributions for the business, I'm going to save 15.2% FICA on that $90,000. So that comes out to being about $13,000 in FICA taxes we saved there.
Okay.
And I also get something called a qualified business income deduction on that $90,000.
Tell me more about this.
Yeah. Back in 2017, during the Tax Cuts and Jobs Act, businesses that are not specified service trader businesses are eligible for something called a qualified business income deduction, which is equivalent to 20% of whatever your profit is coming through a pass-through entity or a sole proprietor business. So essentially 20% of that 90,000 doesn't get taxed. And so that's 18,000 of tax-free profit that you get from your business. Now, say I am in a 30% tax bracket. That's going to save me about $6,000 in tax.
Wow. Because you rearranged yourself.
Just rearranging my compensation structure. So now I'm at 13 plus 6, about $19,000 to $20,000 in tax savings by saying, I'm not going to pay myself the $150,000 on a W-2. I'm going to do a little planning, set up a proper structure, obviously make sure that I have support and documentation on why I'm paying myself this amount of money. But I'm going to save $20,000 a year in taxes ongoing. And we see this time after time, coming from, other small businesses out in the marketplace that either they're overpaying, they let their sole proprietor business or single member LLC business get too much profit and not save on the taxes by doing this. Or they made the switch to the S Corp, right? They had the right idea, but nobody did planning with them. And we're just way overpaying ourselves on a W-2. And we're just, leaving $20,000 a year on the table.
In reality, the owner or the business is still making the same amount of money, roughly.
Correct.
It's just being allocated a little bit differently.
Yeah, we're just putting it in different buckets.
Yep. And those buckets are ended up saving everyone some money.
Absolutely.
All right. Well, perfect. Let's move on to the next one. Pass-through entity taxation. We did a whole podcast on this before.
We sure did. And I'm still for some odd reason, I'm seeing not just this missed, but sometimes even done wrong. So missed. So what is pass-through entity taxation? We'll put a link for a more in-depth explanation of it. But essentially, we're allowed to pay state tax for a pass-through business. We just talked about S corporations. Pass-through business, you pay tax at your personal level, not your corporate level. However, the IRS lets you do, or now allows you, or states are now allowing you to elect pass-through entity tax. So I'm paying my state tax through my business, and I'm getting a tax deduction for it. So say I have a $300,000 profitable business, And in Illinois, it's 5%. I'm rounding it up from 4.95 to 5 for easy math. So we're going to pay $15K in pass-through entity tax. And in my tax bracket, still 33% federally. I save $5,000 a year for just paying my state taxes through my business versus personally. So it's a big
Seems
win.
like a big deal. Yeah.
Totally. In some cases, it's as simple as that. So Illinois, for instance, same rate for personal income taxes versus pass-through entity tax. So it's a no-brainer decision. We're going to make that every time if you're a sole shareholder or Illinois resident shareholder with an Illinois business. I just came across a return, Wisconsin business. They paid, Wisconsin calls it different. They call it entity level tax instead of pass-through entity tax. A little different process, similar result, except the difference is in Wisconsin has a graduating state tax system, and personal income taxes cap out around 5.5%. You get taxed at corporate level tax in Wisconsin if you apply this, and that's about 7.9%. So there's a rate difference. Mm-hmm. So it doesn't always make sense. And in this case, these individual shareholders had very low federal income tax brackets for the year, but they paid the entity level tax. So they actually lost money by making this.
Sound like it's a win. Yeah.
You have to understand the nuances for each state and how they apply it. You do a rate comparison, and then you got to just do the calculation. It takes 5 minutes, especially if the dollars are sizable, especially if your income is more variable. Just do a little calculation, make sure it still actually makes sense. In this case, they left some money on the table. So I've seen, I guess, people that don't quite understand each state's nuance leave money on the table, and people who just blew off as a whole leaving money on the table.
Seems like a waste.
Sure does.
Now, what was the last one here? What their CPAs are missing?
Yeah, we touched on it slightly when we talked about the S corporation, but it's the qualified business income deduction, or QBID.
I love these acronyms.
Acronyms, right? The IRS loves acronyms. They love acronyms and tax code. Some people can just rattle tax code off.
Can you imagine working there and you probably have like on their desk just a list of acronyms?
We do have a glossary of terms here at the firm for acronyms. So I guess we're in the same boat there. All right. Qualified business income deduction. So I don't as much see this one completely missed. Well, what I do see is this is not planned correctly. So qualified business income deduction. So we get this deduction based on profits of my business. So my profits of my business can be my operating business and also certain types of real estate income. Now, they both have different limitation factors. So my business, my qualified business income deduction for my operating business is limited to 50% of the W-2 compensation paid out. So money that I paid out to my employees. Mm-hmm. We've seen a case where very profitable businesses with very low wages run into limitations on this. And we've done some techniques that have found a way to maximize that benefit. So we've maybe aggregated some certain types of businesses together, a little bit more complex things, to make sure we get that full deduction. But where we see more of an issue is misclassification on real estate. So in our opinion, real estate rentals, for the most part, qualify for a qualified business income deduction. Maybe in some very few cases where you're like truly a super passive investor in that real estate where you don't qualify for that.
Quick question, just so I know, what would that real estate investor be? Like what type of business or what are they doing?
Oh, the entity type or anything like that doesn't matter. It's more about the activity of the business. So if you're
what activity would they be doing?
They're completely completely uninvolved.
So what type of company though?
Oh, it's a real estate rental. So I own a piece of property, whether it's an LLC or partnership or whatever type of entity. That part doesn't matter. What matters is what's actually being done.
Yeah. So something like an apartment complex would be an example.
Exactly.
Perfect.
Yep. So an apartment complex. So now, obviously, when you rent real estate, there's generally not W-2 wages being paid.
Because you really have no employees, right?
Correct.
You just have
building
place that you're offering them to live.
Correct. So now they do 2.5% of something called UBIA, because I know you love that. It's unadjusted basis. So essentially what you bought the asset for, right? So I bought the apartment complex for $500,000. So 2.5% of that is $12,500. So that is the limit of my qualified business income deduction. Now let's say, and let's step back. Let's call this the building in which my business operates.
Okay.
Because we have more control over that. Otherwise same inputs. So our qualified business income deduction is 20% of profit, limited to $12,500.
Okay.
Well, when my business gets my qualified business income deduction, if I'm paying rent back to a building that I own, I control that, and I'm taking away income that gets a qualified business income deduction. If I pay too much rent to my building that I own, all of a sudden I don't, that deduction's limited. And I'm leaving money on the table with something that I control, right? So maybe I got to look at my rent and how much I pay myself in rent and make sure I don't have too much profit in my self rental to not maximize my qualified business income deduction.
Does this matter if you have multiple rentals? Because you mentioned that it's where your business is set up.
So it can. So that would matter. So there's rules in which we can aggregate all of our real estate together and measure it as a conglomerate versus as each individual activity and parcel. But otherwise, if they're completely separate and unaggregated, then it doesn't matter.
Perfect. That's a lot of things that are being missed. I shouldn't say it's a lot of things being missed because it's not like tax code is easy to memorize, right?
And it's not like it, and most of these are just not things that are being missed. These are things that are available to pretty much every single business that we see walk in the door. And a lot of times it's just not planned. It's not planned. It's not analyzed. And that's what happens sometimes when you have a preparation service versus a comprehensive planning and tax and
it's the difference of just throwing them together. Here's my paperwork, Eric. Please make me correct, right?
Yep.
As opposed to working together and having a strategy, which we've talked about many times before.
Absolutely.
Partnership. We're actually communicating so you can plan.
Totally.
Anything else you want to add to this?
I think that one covers it for today. Maybe in a future one, we will do some unheard of tax strategies.
Unheard of tax strategy. It sounds like an animal that has never been seen on this planet before.
Exactly.
It just got discovered.
Yes.
Perfect. All right. Thank you, Eric.
Thank you.
You've been listening to Kaizen Time, part of the Blood, Sweat, and Business podcast. If you like what you heard, subscribe and leave a 5-star review. This podcast has been brought to you by Kaizen CPAs Plus Advisors, providing advisory and accounting services to help you grow your business. Learn more at kaizencpas.com or email us at bsb@kaizencpas.com.